Take of the Gotrocks family and the real game of index funds. The Little Book of Common Sense Investing Part 2. In the darkness of the night, a man was looking at his investment statement repeatedly. The market was up, the news was positive, yet why did his return look lower than everyone else's? He had thought that expert advice would make him rich quickly. But every year fees were being deducted, trading costs were being deducted, and his money was quietly beginning to grow tired. The fear begins right here. If the market is making money, companies are earning profits, then why exactly does the full benefit not reach the hands of the common investor? John Bogle explained this very question through a very simple story. In part 1, we knew that an index fund does not try to beat the market, but rather tries to own the market. We had seen that in a mutual fund, a fund manager puts your money into selected companies, whereas an index fund follows rules and gives a share in the growth of the broad market. The biggest lesson of part 1 was exactly this: looking smart in investing is not necessary. What is necessary is making a long-term journey with low cost, diversification, patience and common sense. Now in part 2 the story gets deeper. Here Bogle tells us the parable of the Gotrocks family, which looks simple but shows a mirror to the entire financial industry. Imagine there was a very big and wealthy family in America. The name of this family was Gotrocks. They owned the shares of all the public companies in America. Whenever a company earned a profit, the Gotrocks family received its share. When the economy grew, industries grew, and businesses became strong, this family kept getting continuously richer. There was no worry in the family. They owned the entire market. No one had to guess which stock would be a winner and which a loser. They held the entire business world. Some companies did excellently, some remained average, some weakened, but taken all together, the family kept receiving the benefit of corporate growth. Then one day, some smart-looking experts arrived. They said, "You people can become even richer, you just need to start buying and selling shares with your cousins." The experts explained that some shares are good and some are less good. If the right selection is made, some members of the family can earn a higher return than others. The Gotrocks family found this idea very exciting. Now everyone felt, why take just the market return when an extra return can be earned with an expert's help? But the problem was hidden right here. Because the shares were just moving around inside the family, one member would sell, another would buy, but the total ownership of the entire family remained the same. Earlier the family used to get almost the entire business profit. Now advisors came in the middle. Every advice had a fee, every transaction had a commission, and every activity had a cost. Slowly the family understood that the total profit coming from the market is the same. But now, experts are taking out their share from that profit first. After some time, instead of increasing, the returns began to decrease. The family was surprised because activity had increased, meetings had increased, reports had increased, but less money was being left over. Then they thought that perhaps the advisors were not good, therefore even bigger experts, more expensive managers and more sophisticated strategies were hired so that the result could be better. Now trading increased even more. Shares began to be bought and sold repeatedly. Managers kept getting fees, brokers kept getting commission, and the net return of the family kept falling again. This is the very point where Bogle's parable hits hard. The market is a pie. If more people cut slices in the middle, less will be left on the investor's plate. The Gotrocks family finally realized that they were wiser before. When they held the entire market, the business growth came straight to them. Corporate earnings versus market performance. Bogle's message is exactly this. If you own the broad market and avoid unnecessary activity, your chance of getting a fair share of the market return increases. Here, the words fair share are very important. An index fund does not guarantee you a return higher than the market, but it tries to save a large portion of the market return. In active investing, the goal is to beat the market, but in the entire market, all investors together make up the market itself. Therefore, the average investor earns the market return before costs. After costs, the picture changes. The investor who pays more fees, more trading and more taxes, their net return can fall below the market average. This is the reason why Bogle talks about low cost repeatedly. He says that an investor becomes rich not from the market return, but from the amount left over after the market return. Now understand market behavior. The price of a share changes every day. Sometimes there is an actual improvement in the company, and sometimes only people's expectations change. According to Bogle, in the long term, the earnings power of a company drives the share price. Meaning, how much money the company is actually earning is the strongest foundation. If a company increases sales, increases profit, and strengthens future cash flow, the value of its business can increase over time. But in the short term, the market is not always calm and logical. Sometimes fear drops the price. Sometimes excitement takes the price very high, and people mistake it for growth. This is where the PE ratio comes in. PE means price to earnings ratio. It tells how much price investors are ready to pay for 1 rupee of earning. Suppose a company earns 5 rupees on every share, and the share price is 100 rupees. Then the PE will be roughly 20, because the price is 20 times the earning. If that same earning remains 5 rupees but the price becomes 250, the PE will go very high. This means that investors are expecting big things from the future. PE is not just mathematics, it is also the temperature of emotion. A high PE often shows optimism. A low PE often shows fear, doubt, or low expectation. But a high PE is not always wrong, and a low PE is not always cheap. Sometimes a company can truly grow rapidly, and sometimes a low PE can be a value trap as well. Therefore, Bogle says that in the short term, the market runs on expectations, but in the long term, reality comes forward through earnings power and true business strength is seen. A company can fly on news, fall on a rumor, or become expensive in temporary excitement. But years later, the question remains the same. How much did the business earn? This same thing applies to the entire market as well. The economy grows, companies earn, give dividends, reinvest profits, and investor wealth is built slowly. An index fund gives a share in this very broad growth. It does not claim that every year will be excellent. It says, own the entire market and keep costs low. The cost of restless behavior. The mistake of the Gotrocks was exactly this, that they made simple ownership into a complex game. In their attempt to choose winners, they gave too much power to middlemen. The common investor makes this same mistake too. He searches for the best fund every year, panics at every fall, and makes a late entry into every rally. Many times, it is not the market that causes more damage to the market. The investor's impatience does, fees do, and the habit of changing decisions repeatedly weakens wealth. Bogle's common sense investing teaches us slow discipline. Put money, diversify, look at the cost, and let time do its work. This does not mean that there will never be a loss in an index fund. If the market falls, the index fund also falls. This is not a safe deposit, it is equity ownership. But the difference is that you do not put your entire hope on one manager's mistake or one company's collapse. You own a broad business basket. In India too, this same logic can be understood. Nifty 50, sensex, or broad market index funds give the investor a share in the combined journey of big companies. Here too, understanding cost, tracking error, and fund structure is necessary. Investing just by looking at the name is not right. Along with low cost, tracking the index correctly is also necessary. In part 1, we understood that mutual funds and index funds are both pooled investment vehicles. The difference is that an active fund chooses, an index fund follows. In part 2, we are understanding that choice has a price. Every expert, every trade, every layer, and every promise can take out money from the investor's return. When the Gotrocks family owned everything themselves, the market growth was theirs. When they put experts in the middle, a portion of the growth started leaking away in fees. This same thing applies to the small investor too. Your salary is hard-earned. If an investment return comes, a large portion of it should remain with you, not with the system. There is one more lesson: avoiding excitement. As entertaining as investing looks, it can be just as dangerous. Too much noise, too much confidence, and too much action often become costly. Bogle wanted investors not to be scared of the glamour of the financial industry, but also not to trust blindly. Look closely at the cost, incentive, and risk behind every product. If someone says that he will always beat the market, ask a question. For how long? After fees? After taxes? After risk? And is this repeatable? Index investing demands humility. One has to accept that the future is uncertain. No one can catch the right stock, the right sector, and the right timing every time. But a path is possible in the midst of uncertainty: ownership of the entire market, low cost, less activity, and long-term holding. This is the practical answer to the Gotrocks parable. Another big lesson of market behavior is that price and value are not always the same. Price is visible every day, but value is built slowly from business performance. In the short term, PE shows the mood. In the long term, earnings show the strength. Therefore, an investor should understand business reality more than daily price movement. When people are very excited, they buy the future very expensively. When people are very afraid, they sell even good assets cheaply. Bogle's path gives a balance between these emotions. The index fund says, do not react to every emotion. Own the market and stick to the process. In reality, index investing can look boring because there is less daily drama in it. But many times the most powerful path of wealth creation is the one that looks simplest from the outside. The story of the Gotrocks family reminds us that activity and progress are not always the same in the financial world. Many times doing less can give a better result than doing more. The real lesson of this part is that in investing, your enemy is not the market, but unnecessary cost and restless behavior. Do not make a simple game complicated like the Gotrocks. Now the story stops here, but the next question is even more important. If an index fund is so simple, then how do fees, taxes and compounding together change your return? In the next part, we will see how a small expense ratio, which looks minor at first glance, can eat away how big a portion of your wealth over a long time.
If this video has taught you something new, or if you feel this information should reach more people, don't forget to like and share the video. Your small share can become valuable and useful information for someone else. If you have any questions related to this topic, or if you would like to share your opinion with us, be sure to write in the comment box. We read every question and suggestion from you, because your feedback inspires us to create better content. And if you want to keep receiving such interesting and reliable information about business, the economy, and the world in the future, then don't forget to subscribe to our channel GRT Business and also press the bell icon so that you get notifications of every new video directly. At GRT Business, we always strive to provide you with accurate, balanced, and reliable information. Our news and analysis are prepared based on information obtained from various news agencies, public sources, and public opinion. We make every effort to verify and validate each fact as much as possible, but in case of any possible error or dispute, the responsibility lies with the respective sources. Our only aim is to present you with a correct and trustworthy perspective so that you can understand any topic better.